Hey, welcome back to YT Finance, and before we begin this video, I just want to give you a quick portfolio update. 2 years ago, we started a portfolio where I started out with just $2,000, and 2 years later, we are now at $61,927, and I just spent another $10,000 on the stocks you are about to watch in this video. Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about the best explosive growth stocks to buy right now in 2023 and beyond. For more of the best stocks to buy, remember to go and annihilate that like button, subscribe if you are new, comment down below what stocks you are buying right now, and without further ado, let's just jump right into it. Clearly, the overall stock market has been very volatile, especially for technology stocks. It's been absolutely brutal in this bear market, but I think right now is one of the best times to accumulate shares that are currently trading at a discount. So I'm going to highlight some of the companies that I have been buying literally throughout the last few months. Many quality stocks have fallen by around 50%, which means that your money is going further because you're buying twice the amount of shares that you could a year ago for much cheaper prices. So this could catapult your wealth over the long term. So let's start off with my first stock on this list, which is the Trade Desk, ticker symbol TTD. Right now, their current share price trades for $50.70. However, professionals believe the company could fall all the way down to $27 if we enter into a bearish mild recession, or the company could surge up to $90 if they continue on their amazing growth trajectory. So let's talk about what this company does. Essentially, the Trade Desk is a cloud-based demand-side ad exchange that lets advertisers create ad campaigns. This means they are making the majority of their money through advertising. So why is this good? Well, recently, the US Department of Justice filed an antitrust lawsuit against Alphabet, who owns Google and YouTube. And essentially, this lawsuit is over Alphabet's dominance in the digital advertising space. So, depending on what happens with this overall lawsuit, it's going to open up more market share for the Trade Desk to capitalize on. Digital advertising has been dominated by companies like Alphabet and Meta Platforms, which was formerly known as Facebook. So this is going to open up more growth avenues for the Trade Desk to give advertisers even more control, and this is going to help the company grow over the long term, which is going to positively impact their overall share price. The company has literally tripled their overall revenue over the past few years. So this company is rapidly growing, rapidly expanding, and the Trade Desk is already very profitable. Right now, currently they're turning around 32 cents for every dollar of revenue into free cash flow. So fundamentally, this is a very solid company once we look at their overall financials. And if you want, you can see a graph on screen which takes their overall revenue, where they're bringing in around $1.483 billion, and they are turning that into free cash flow to where they brought in $485.05 million. The best part about this company, in my opinion, is that the stock has already fallen by around 50% since its highs. This gives investors a better buying opportunity to buy now instead of buying the same company a year ago. Now, right now, according to their accounting ratio regarding their price to sales ratio, which compares their overall revenues that they are bringing in on a yearly basis to their overall market cap, right now, they're trading at a multiple of around 17. And ideally, we would want that closer to around 10 or 12 for a rapidly growing company. So it is arguable that the company is trading at a premium, but still, we're getting a 50% discount from what the company used to be trading at. And right now, according to a research organization, the digital ad market could double by 2030 to $1.25 trillion, which means that the Trade Desk's opportunity for growth is unparalleled within this particular industry. Overall, the Trade Desk seems like a great long-term investment for long-term shareholders. The next company we have, which is an amazing company that I have bought up recently, is CrowdStrike, ticker symbol CRWD, which currently trades for $105.90, while professionals believe this company is already trading at a discount, meaning that it's undervalued right now, because even the most bearish negative professionals during a recession believe the company should be trading at minimum around $110. Clearly, the current share price is lower than that, which means investors investors are getting a phenomenal discount. And on the other hand, we have very bullish investors who believe this company could reach a price target of $385 over the next 12 months, literally over tripling their current share price. I personally think that the true share price and price prediction should be somewhere between these two price targets instead of taking their minimum and maximum, but this does mean that the company is currently undervalued right now. This is a cloud-based cybersecurity company that can update its overall security in real time. So CrowdStrike is solving multiple problems for a plethora of various businesses. What I like about CrowdStrike is that they are bringing in new technology and they represent the new generation of companies offering these types of cybersecurity cloud-based solutions. And this means that technologically they are one of the best investments when it comes to the evolving cybersecurity market. So overall, this is a phenomenal company. Traditional antivirus software platforms normally are installed locally on a device and then they receive periodic updates. However, CrowdStrike, because it operates off of the cloud, it's literally always updating to the newest threats in real time. So it's no wonder why so many organizations trust CrowdStrike with their data. As of late, their revenue has passed over $2 billion over the past year, and professionals believe this company will grow at a 30% CAGR in terms of their revenue, which means that they will grow at a 30% compounding annual growth rate from now over the next 4 years. This means that this company is rapidly scaling, rapidly growing, and that also means that we should see this reflect in their overall share price absolutely skyrocketing and exploding over the next half decade. I also like the business because they are fundamentally strong, where they're generating around $594 million in cash profits with a 29% conversion rate. In essence, this company is not only rapidly growing, but they're also a great investment opportunity because right now the share price of the company is trading at around a 60% discount from their former highs. Their overall accounting ratio in terms of their price to sales ratio is only 12, and that's exactly the range that we want to buy these innovative growth companies, between a 10 and a 12 PS ratio, which is going to be dependent on their overall growth rate. This is one of the cheapest times to buy this company since they went public back in 2019. They are a rapidly growing company, they have very strong financials, and I think it's an opportunity for investors to gain wealth over the long term by buying this company literally right now. The next company we have is Snowflake, which is a Warren Buffett company that he has personally invested into regarding his Berkshire Hathaway portfolio. Right now, Snowflake's share price, ticker symbol SNOW, is $156.44, while on the low end, professionals believe the company could drop to $105 if the economy enters a very bearish negative recession, but if they continue their growth trajectory, the company could be worth as high as $500, according to very positive bullish analysts. If you're not familiar with this company already, Snowflake operates a cloud-based platform that lets businesses store and analyze their data so they can create and enact better directives for the company. By utilizing and leveraging their overall data analytics, it allows a company's management to better dictate and better forecast the future moves that they should make for their company, leading to better revenues and overall growth. Snowflake's annual revenue is approaching around $2 billion, and they are free cash flow profitable. On top of that, management is targeting a $10 billion revenue forecast by fiscal year of 2029. I personally think right now the company is trading at a rather high price to sales ratio of 26, so I would wait for this company to cool off even more, even though the share price of this company is currently trading at around a 60% discount, but I do think they could trade at even a cheaper valuation. But all in all, Snowflake still has long-term revenue guidance that is very impressive. But if you found that all three of these companies so far have been rather expensive, let's move on to a cheaper company. However, the company we will be analyzing next is rather risky, and that is StoneCo, ticker symbol STNE, which is a Brazilian fintech company. As of late, they have served up some strong results, but they did have a blunder trying to offer various types of credit to small and medium-sized businesses. StoneCo right now trades for $11.16, while professionals believe this company could be worth as little as $2.36, or at maximum it could be worth around $16.98. But what am I doing with this company? Well, honestly, I have a very small position in this company because it is extremely speculative, but the share price is very cheap, so based on the current growth rate, I was like, why not throw in a few $100s? StoneCo's price is right now trading at an 88% discount, so there's no doubt that this company is trading at a pretty good deal right now. However, this is a high-risk, high-reward stock. Fintech valuations have been pushed lower as of late, but this could open the door for explosive upside. I think a better fintech company to buy would be companies like SoFi Technologies, or one of my favorite companies, which would be Mercado Libre, ticker symbol MELI, ticker name MELI. However, the growth of this company is absolutely astonishing, to where their revenue grew by around 71% year over year as of quarter 3, and their adjusted net income jumped by around 90.5%. This is very good growth, but there is going to be uneven growth going forward considering current forecasts. Right now, this company is attractively valued, but this is only for risk-tolerant investors. To really receive the payoff for this company, you're going to have to hold it for quite a while, and that's if they deliver on their overall promises. There is going to be further financial hurdles for this company in the near term, but over the long term, this could be a pretty solid investment. But again, if I had to put all of these companies in order, CrowdStrike is easily number 1, The Trade Desk is number 2, Snowflake is number 3, and then StoneCo would be number 4. But in essence, all of these companies are absolutely primed for future growth, and I can't wait to see what these companies make of themselves in the future. So with that being said, remember to go and smash that like button for more videos just like this one, subscribe if you are new, comment your thoughts down below about which of these companies you like the best, and I will see you in the next YT video.